Hi, I'm Stephen Carson coming at you from St. Louis, Missouri, in these United States. We're going to talk about some current sort of economic news. And I just wanted to mention something. Mad Mercenary reminded me that I should be telling you guys we have another competition this year. We've been doing that. This will be our third, I think, time that we've run an annual competition. The judging usually happens sometime in between Christmas and New Year's, but people often start getting to work on it or getting submissions in now at the Discord. It is a book cover design competition. The rules are laid out, so just join the Discord to see the rules, and we usually give away some silver coins or something like that. Um, so yeah, that's what I wanted to say there. Support the show on Subscribestar and through our public Bitcoin wallet. Thank you for some generous recent donations. Okay, let's bring on our special guest, co-host, whatever to call you guys, Ryan Turnipseed. Hello.
Hello, how are you?
Very good. And Black Horse.
How are you doing? I'll have you know I was demoted to guest number 3 this week. So
No, you're number two. I see. I'm not a guest, so then Ryan's guest
there
number
you
one,
go.
and you're guest number two. Anyway, yeah. Um, okay, so okay. Well, I want to call out a theme. I don't know how much we're going to hit it today, but I liked what we were chatting about, Black Horse, before this, which is that. No, I'm not going to talk about that. Okay, we'll get to it. Okay, let's start off with an article. In fact, I would say this whole show is going to roughly have a theme about inflation. Pretty much everything we cover is related to at least price inflation, if not what Austrians would consider inflation. Um, but let's start with a little bit of theory. This is an article on Mises.org from just yesterday called Low Interest Rates and High Taxes Won't Help Against Inflation. The Economy Needs Savings and Real Investment. Now, interestingly, this article is a
now
little
we
more
should
oriented towards
probably
England. Go ahead.
we should probably background this where this show comes like 3 days after the Biden regime passed the quote unquote Inflation Reduction Act.
Right.
The Inflation Reduction Act is an exercise in modern monetary theory designed to combat inflation by raising taxes. So inside the MMT frame, inflation is a phenomena of excess cash in circulation. So if you draw cash out of circulation through through taxation, that should be anti-inflationary. Equally, within their frame, if you have state spending to increase economic efficiency, you should make more goods available and reduce inflation. This is sort of MMT 101, how to deal with inflation. And so that's why you have Mises writing an article that says high taxes won't help against inflation because,
Right.
the present plan is raise taxes to reduce inflation.
Yeah, so I'm sorry, I haven't engaged with MMT that well. Explain something simple to me. So if they raise taxes and then take the money and spend it, the money's still in circulation. So they're supposed to raise taxes, take the
Well,
money
so
and bury it, or what?
that yeah, so the correct MMT move is to take the money out of the economy with taxes and bury it by paying off debt or something, right?
Ah,
Um, do
okay.
not re-release the cash into the economy, or if you do it via long-term spending projects, that kind of thing. And this is supposed to the MMT theory of economics. You can equate basically to like a the way that video game economics work, right? Where you've got sinks of resources and you've got sources of resources, and you try to balance out the sources of cash and the sinks of cash in order to manage the price of goods inside the system. A good sink of cash is taxation. A good source of cash is the government handing money to people. So if you were concerned about inflation, you might send checks to random people, and if you were not concerned, if you were concerned about if you were concerned about deflation, you would hand checks to random people.
Okay.
And if you're concerned about inflation, you tax them to take their money away.
Right, and it should be noted that you get. Let me see if I can remember this correctly. The end goal is to constantly utilize all available resources that currently are not being utilized, so as to increase efficiency. And the thing that it's either heavily drives up inflation or heavily drives up prices is, I believe it is competition for resources between the private sector and the state, if I remember correctly.
Yeah. There,
Is how they phrase it.
we could have a long lecture about MMT and its weirdness, but there's your 30-second primer for the
Okay.
sake of
Yeah,
understanding what Mises is writing against, right?
It sounds like the full employment target just got swapped out for a full resource
Well,
utilization target or something.
Right. That's exactly what it is.
Smart.
Yeah.
Okay.
Same premise.
Right. Yeah. Okay. So he's a little bit focused on the England side of things, but that's okay because I think it's, well, I don't know. You tell me, Black Horse, but I kind of get the feeling that the say the U.S. Federal Reserve and the Bank of England aren't pursuing drastically different approaches generally.
No, that would be fair.
Okay, that's my impression, but I don't study the Bank of England carefully usually. So, okay, so he talks about CPI hitting a 40-year high of 9.1%. We'll come back to that in a bit. Bank of England has raised interest rates from 1.1% to 1.25%. And he says this is a poor plan.
Yeah.
So he says, first, inflation must be defined by its cause rather than its effects for the monetary authorities to enact a sound recovery policy. Yeah, so this is in my work world, we talk about, maybe you have this term too in your world, Black Horse, root cause analysis, right?
Yep.
People will even say RCA, like, yeah, I know that such is happening, this symptom is happening, that symptom is happening, but what is at the bottom of this? What is the thing we need to, that's really causing all this? And then we can figure out what we're going to do, right? So that's what he's saying. He's saying we have to figure out the cause of inflation. And so in proper Austrian style, he says inflation is an excess increase in the money supply over the real demand for money. Now, actually, I'm not sure that's quite Austrian, Ryan, to be fair.
That sounds very much like what I would hear in my microecon class, which seemed like a blend between just mainstream Keynesianism and a Chicago style. So
yeah, I mean, it's true we would focus on money supply for Austrians, but I don't know that we'd be comparing it to demand for money.
I believe that we would be saying it's just an increase in fiduciary media, would we not?
Yeah, right. So this article's surprisingly from Mises.org. There's a few things that aren't very Austrian about this, but it is interesting nonetheless. Okay. Yeah, so he says real demand for money has to do with individuals withholding current consumption and preference for future consumption. That is, if you're holding money, you're not spending it, right? That's the point there. And that takes us to time preference, as he brings up. The time preference for future current consumption lays the foundation. And he says inflation is not simply a monetary phenomenon, but a monetary and time phenomenon. And I don't know what I think of that. What do you think of that, Ryan?
Well, I will take it very basically, and I will basically say this whole time preference idea we will be rolling with for this article. Time preference, withholding, let me see if I can phrase it correctly, preferring the same satisfaction now rather than later. So how you fare based on that statement would be your time preference. Depending on how most other people how they are doing with that. So if people very much prefer present satisfaction now rather than the same later, they will basically need consumer goods or something similar in order to satisfy whatever want it is in order to bring about that satisfaction. And if you have lower time preference, you are willing to wait longer is the very, very basic. And this time preference leads us to interest, which is, you know, how how costly is it to withhold using your money and instead lending it to someone? So that premium that you put on that withheld money that you were loaning out to someone determines the interest rate, that premium that will be paid back. And this then brings into a return that you can get on various types of production. So if I basically if I withhold my spending and lend it out to someone, and they produce something, I'm going to get a sort of return on that interest. And in a free market, this will even out over time. People will go to where there's the highest return based off of interest. Typical basic phenomenon that you can see elsewhere in studying the market. And I think that's a pretty good setup for the triangle that will help elaborate more on this and hopefully make it understandable. Because interest rate theory seems very opaque looking into it, but it's if put into plain terms, should not be that terribly hard to understand. So can I talk about the triangle?
Yeah, so let's get into the Hayekian triangle. I might have covered this once before on the show, but I haven't tended to use it. We have talked a lot about stages of production and more roundabout production, right? So what does that mean in this Hayekian triangle? Along the x-axis, the horizontal axis, is the stages of production. As you go to the right, you're getting to consumer goods, right? As you go to the left, you're getting more and more distant from consumer goods. So when we talk about a more roundabout style of production, then the bottom of this triangle is going to get wider, right?
Right, and I don't know that saying roundabout is necessarily the correct word, because it could just be that it's we have the ability to produce more complex goods, like say computers, that will take more and more stages of production that you wouldn't have had if you were producing, say, like a chessboard or something.
Well, in classic Hayekian triangles, the length of the is the same good you're producing. The question is how long the chain of production is, right? So modern chains of production for pencils are very long. Classical chains of production for pencils are quite short.
Right, and the thing that you'll see is another principle that we should lay out is that those things to the left of the triangle, I believe it'd be the higher order goods, the mining, the pickaxes, the actual mines, the metals that they're producing, have value because consumers value the end product. That is, value is imputed into to the left of the triangle. This is what producers are trying to estimate and go off of. If they don't think that consumers will buy the pencil for this cost or whatever, or this price rather, they're not going to go above that price costs.
That price signal finds its way all the way back to the mine, right?
Right.
Yeah.
So
exactly.
As time progresses, these typically, as people accumulate more capital or grow wealthier, you can have a million different factors that go into this. The triangle will elongate. That is, the structure of production will become more and more complex. Typically across the board as a civilization's population, wealth, the division of labor, and specialization all increase. And typically, let me see if I can phrase this correctly. As that increases, you're investing more and more into the production, which means that people have to save in order to lend out that money in order to produce. And you can derive that from Robinson Crusoe theory. People are going to be consuming less, generally, is the very basic explanation. So as the triangle becomes more complex, as it gets longer, consumption will decrease because people are saving more in order to produce more for later. So that's the free market. That's how people would normally act.
Right. So just to make this triangle real simple then, so the bottom is gets longer as your production process gets more complicated. I guess there's more stages
Right.
of production, and then the vertical goes up and down in terms of the output of consumer goods, right? So
Right.
a an economy that is being low time preference is going to be you have a flatter triangle, right? You're not going to be like consuming everything. It's going to be
Right.
productive, so there's going to be some vertical height for sure, but you're not consuming everything you could be. And along the bottom, it's going to be wide because you're investing, you're saving, you're allowing for these more complicated stages of production. An economy
Right.
that's burning itself out, eating the seed corn, all that sort of thing, it's going to narrow along the bottom and go up in terms of consumer goods. It's going to start consuming everything, right? And
Right.
and that can't last. At
And
its
it's
most
not
extreme, that can't last.
right. Yeah, that is an extreme. It should be pointed out.
Yeah,
Normally, absent artificial intervention, time preferences will change based off of people. So, for instance, if a region gets hit, for example, by like a hurricane, you're
yeah,
probably going to see the time preference increase because
right,
people need to make sure they live the next day in order to plan for the future. So,
right.
if they were producing something, this triangle is going to get very tall and very short
Very,
just to make
very
sure that
narrow.
people live.
Yeah,
Right.
tall and
Yeah,
narrow.
narrow. Sorry.
Right, right.
Um, and
Okay, so
uh,
let's bring us to the next triangle. Okay, ready?
right,
Um, okay, and he talks about the interest rate. Um, as economic actors restrict their current consumption in favor of future consumption, social savings pool. This allows the interest rate to fall as there are more financial resources available for loans, investment, and expansion. Remember, best way to think in the free market, at least, interest rate just means the price of uh, borrowing
lending
money
or
of
borrowing. Yeah.
using something for sort of a future project.
So,
Okay,
and
so this is normal. Now let's go to the second triangle, and he's saying that that dotted line, hopefully y'all can see that fairly well, that dotted line is what the kind of shift we've seen as a result of lockdowns, furlough schemes, and so forth. Um,
right. So go back to that interest example. As people save up more, the interest rate will fall. Think about it from like the perspective of a lender. If you save up $1,000 that you're willing to lend, whereas previously you had 100, um, you know, suddenly you might see it as less risky, for instance, on your end, if you were to lend it out
mhm,
and not get the immediate payment or something like that. There's less
right,
risk involved, you might say. Uh, Not the exact prim and proper terminology, but from your perspective, if you have more money that you have been saving and you lend it out, it's not as expensive for you, not as risky for you, et cetera, et cetera. So you don't need to charge as high. And if you do, then someone else will if they have also been saving. So it keeps going down and down as people save more. With this triangle, where it is very long going leftwards and very tall on the vertical scale, but also indented in the middle, uh, what has usually happened is that fiduciary media, fiat currency in our example, central banks have printed more of it. The fiduciary media supply has increased and it has been given to people. So producers think that they can make very, very complex and very intricate uh, means of, or sorry, structures of production. So this
oh, yeah, right,
increase in money, producers are going to think that they have much more resources available than they might actually have, and they are also thinking that consumer demand is going to be this. People will want these goods at this price, hopefully. So they go into more and more complex structures of production. The triangle goes out much farther. This takes time, remember. As you go from left to right on the triangle, those stages of production take time, uh, which is where time preference comes in. That's why it's directly related to this triangle. But also, since that fiduciary media has increased, People are going to be spending it. Demand isn't going to fall, or consumption isn't going to fall, whatever you want to call the end for your basic purposes, like it normally would, because they didn't save up to get this money to lend out to give to producers. So instead of the triangle becoming shorter on the vertical scale and longer on the horizontal scale, it's going to stay the same or increase or whatever it would normally, quote unquote, do on the vertical scale, and get much longer on the horizontal scale. Things will get more complex, consumption will stay the same, and the middle, due to the time that this takes in order to make these elaborate structures and profits that you can potentially get at either the early or the late stages, the middle is going to be neglected just because this hasn't happened naturally. There's no normal means to get these sort of middle stages of production to fit both what people are expected to want and what producers are currently investing in. So the triangle kind of bends inward. And what is going to happen is eventually these producers are going to realize that their costs are way higher than what people are willing to pay for them, which means that their investments have been a mistake or a malinvestment. That's not what would normally have happened had the fiduciary media not have been expanded and given out. And they are going to liquidate their structures of production for something more simple, fitting people's time preferences, their demand in the present or in the future. And you're just going to basically see the triangle correct itself. And this is also the boom and bust. The boom being the triangle elongating on the horizontal end, and the bust seeing it retract, going back to what people actually want or need.
Yeah, so slightly non-Austrian perspective in the article, I think. He says another way of looking at the nature of the high inflation rate is that excess money has entered the economy faster than goods and services have been produced. Because remember, he's trying to connect the money to demand or something,
Yeah,
and
this
so he
comes
says,
from a Chicago school idea that says that the amount of money circulating in the consumer economy should be equivalent to the supply of consumer goods. The money supply should increase at the same time, the same rate of the supply of consumer goods.
Right, it's inherently anti-deflationary.
Yeah, so it says with production processes in many stages halted and with furlough, during the lockdowns, with furlough payments going to businesses and workers who were not being productive, the money supply was increasing faster than production during the lockdown. And so that's why he shows a shift up on the right. Money's out there, people are spending it. While we're trying to maintain, or even as Ryan suggested, maybe even elongate structures of production. So we're trying to have the triangle go up and get wider simultaneously. And that's not stable. Right. That's the
a good way to think about this is that it's a disruptive influence on the price signal. So you have that gray line of the very strong and sudden price signal that eventually will fade back to the black line when people's consumption normalizes, right? So imagine, if you will, that you were an executive in the toilet paper industry over the last 3 years. You saw this massive spike in demand for toilet paper. Now, you probably could have known intellectually, without looking at the price signal, that the number of rear ends to wipe remained roughly constant. But that price signal would have told you that you really needed to ramp up production. And so, if you're a wise executive, maybe you're able to ignore the sudden disruption of the price signal, knowing that it will normalize. But in many cases, it's not going to be as obvious as that, right?
Right, and you can also take it, with that knowledge, you can take it even more basic to the person that is supposed to look at prices and what people want and try to make sure that they can, produce lower than the costs, or have their costs lower than the prices. The entrepreneur, because people can't necessarily just look for certain at a price and at costs and think, well, I can make a profit off of this or not. There is uncertainty there, which means whenever whenever, say, money is expanded and handed out to people, say, just as a hypothetical, the government was handing out money to young enterprising house painters in the year 2007, just as a hypothetical, and the person that was a house painter, the entrepreneur, thinks they can invest in, say, like a new truck or something like that in order to get around more efficiently. It would be an investment. It would have costs associated, but they think that they could paint more houses and thus earn more income than the costs. But since this was money that was printed, wasn't an actual natural earning, we could say, just for very basic purposes. They will eventually learn that people aren't. They didn't want more, house painting or something like that, and eventually, you will have other forces in the market around that time period that will make people really not want house painting caused by other government intervention. So the entrepreneur has then miscalculated as a result of this money being injected just into normal people. And so you see that triangle expanded whenever they bought the truck. Now it is going back in whenever it is no longer affordable, or they have to give up altogether, in which case, for this one individual person, the triangle just vanishes as a result of the miscalculation.
Right. Okay, so I want to continue. I want to continue with the article. He says, why are we only now feeling inflation's effects? This part of the article is a little weird because he seems to kind of go off on a tangent. Having said that, he has some interesting numbers. He's talking about disaggregating the effects of inflation. He says they're not felt instantaneously everywhere because money circulates through the economy at differing velocities for different sectors. So you have your average rate, but he says it's important to look at all the price changes for the goods within the CPI basket to see where the excess money is circulating and how much. Anyway, he calls out some interesting stats here. I'll just highlight real quick. Housing and household services, 31.4% in March 2022. Inflation, 31% inflation. So that's quite dramatic. But then education and communication hardly, they're up 1 or 2%, right? Then on the producer side, PPI changes. Crude oil up 98% in March 2022, right? Another fuel one up very high, 26%. Chemicals up 18%. But then beverages and tobacco are 0.7%. That's a producer input, beverages and tobacco.
Yeah. That's interesting.
Yeah, I'm not sure about that. Okay. Anyway, so then he says, the article's kind of weird because then he says, getting back to it, Bank of England's low rate policy and the high tax rates are not going to curb the rising inflation. He says the high tax rates leave them with less expendable income, force up their cost of living, discourage them from saving. And then government spending contributes to the circulation of excess money. Boy, this is not sounding very Austrian, is it, Black Horse? Anyway, it's not really how we talk about things. But this is what sort of surprised me about this article, is that he ends up being very concrete and saying the Bank of England should raise the interest rates to a minimum of 13.50%. But his point is I don't know about 13.5%, but his point is interesting, which is he wants to encourage saving and real investment that isn't based on, money supply increases. It's based on people actually preferring to save rather than consume. And that point, at least, is quite solid, which is that we need to stop consuming we need to stop consuming if we're going to have real investment that's stable and not end up with that, trying to pull that triangle in two directions and have a bust. But go ahead, Black Horse.
Well, his quantitative point here harkens back to something we referenced in a previous episode called rules-based monetary policy, which is a Milton Friedman Paul Volcker idea from the 1980s, that argues that interest rates, short-term interest rates, should always be, they had the bar set at 3% higher than the core price inflation in order to provide a stable reward for savings. Now, you can say what you want about the aspect of centrally setting interest rates in general, but the point that he's trying to get at here is that in any society where inflation is higher than the rate of short-term interest, savings, it's a society that is actively punishing people for saving money.
Right.
Mm-hmm.
And something else we've also talked about on this show as well, and before I go on to that, it should be noted, having a higher interest rate than, like, what was it, 1.25%, probably necessary, looking at how much people are saving versus how much we are printing and just throwing at people. Probably much more wise at the 13.5% level than what we have now.
Mm-hmm.
But if you are centrally setting interest rates, as Black Horse alluded to, you will have objections even if they are going higher rather than lower. And we discussed this the last time, because in a free market, or I don't know what you might call it otherwise, a natural market perhaps, people will save or spend in line with what actual wants are and what actual production is. Whenever you set a interest rate potentially artificially too high, what you are then doing is discouraging investment or consumption, which is also a distortion just in the other direction. This might sound amazing to us right now, because all that we have known for the last few decades is just artificially lower and lower interest rates. However, you will get just as bad things from the other side as well, which then does bring up the discussion. Do you want to make the central bank run more efficiently by setting interest rates higher, or let it crash and burn potentially, which
Right.
is not what we're going into. Just might throw out the perspective out there that even though it's a better idea, it's still not good necessarily.
Okay, so let's turn from this article and talk about inflation. And here we're again not using the Austrian definition, which has to do with the money supply. We're talking about price inflation, right? And there's an official way to measure this. We've been talking about it. The consumer price index is what people usually talk about. It's a basket of consumer goods that they twiddle with over time. They add, weight some things more and weight some things less, take some things and put some things in, take some things out of that basket. But it's the official way that the government measures price inflation. So we got some exciting news from President Biden. This is only 15 seconds. I don't know if people are going to hear it. Tell me if you do, but I'm just going to play it real quick. Okay, I'm going to restart it, or reload it, and okay, here we go. I'm going to narrate. He says, I just want to say a number, 0. Today we received news that our economy had 0% inflation in the month of July. 0%. Okay. So that month of July might be key. Actually, I'm not very interested in that way of framing it, because I thought that what they're saying there is, Black Horse, that month of July, they're just saying that when you compare July to June, we don't see further price increases from June to July. It doesn't mean the prices are good now. It just means from a certain point of view that even that doesn't make sense.
Even
trying to be
that's not
generous.
correct based on their own stats. So if you pull up the CPI chart,
Okay, here we go. Yeah, I've got it up.
so we're comparing regime statement versus regime metric. Right. We didn't make the CPI up. That comes from the BLS, Bureau of Labor Statistics,
Mhm.
who thinks that inflation as of the month of July was, I think, 8.8%, something like that. Anyways, you can see the chart.
Yeah.
It's up there at like 30-year highs. It's down month over month from June slightly. So maybe that's what they're getting at. It's important to
Maybe.
note this isn't just a Biden gaffe. This is the press secretary came out and reaffirmed this.
Mm-hmm.
So this is what he was supposed to say.
Yeah.
It's the line they're going with.
Right.
So
So
were they instead referencing disinflation rather than, you know, inflation
yeah,
going to zero?
I mean maybe they're saying month over month inflation finally went down. I don't know, but
Yeah, I don't quite
and
get it.
nobody like I read some news coverage on it. Nobody seems to know what the hell they're talking about. So
Yeah, so the financial
News-
press is like, what? So yeah, because what we would expect on the surface from those pronouncements is that this red line would be hitting 0.0. It'd be hitting the axis there, right, Black Horse? That would be my
that's
common
correct.
sense interpretation, and that is not at
The
all
red
where we're
line
at.
at 0 means that 12 months over 12 months you'd see no inflation.
And
Right.
that's why I'm thinking they are actually talking about disinflation, which is just when the rate drops, not necessarily goes negative or
Mm-hmm.
hits zero or anything.
Yeah. Anyway,
Which
we can't make sense of it, but if anyone heard, because I mean, tell me if I'm cynical here, Black Horse, but it seems to me that sometimes they just assume that people are kind of not going to read below the fold, or not read past the headline. They're just going to see zero inflation and
Yeah.
go, "Oh, okay, great. Biden's doing great. Zero inflation." And they're not even going to see the part about it for July or based on measuring it in this weird way that no one has ever done it before. That's kind of the sense I get sometimes. They're just expecting you to not go past the headline.
Yeah, I don't know what they're doing, but it's got to be some kind of message management of some kind.
I mean, the
but
markets, the actual like people who would make financial decisions based on this, I think, people in the markets and stuff, businessmen, are paying no attention to such a crazy pronouncement, I think.
No, presumably it's intended for a political audience of some kind, but
Right.
what
Yeah.
do I know?
I imagine if they said the rate of the inflation rate has gone negative, I don't know if that would have landed as much. They probably just wanted good ratings.
So
Yeah,
just
I
real quick
guess.
to
I guess.
walk through this chart real quick. Like you said, you said it's not quite 9, but it's nearly 9%, right? Up to 8 point something, right? Black Horse. That's where we're at right now.
Yeah, so this is consumer price inflation based on
Right.
their basket. Very famously, their basket was adjusted during the Clinton administration to reduce the appearance of inflation. So
Yeah.
some people like to track the 19, I think it's the 1980 basket that
Mm-hmm.
is famously tracked by Shadow Stats. Anyways, this is their metric. Their metric shows like 8.8% inflation, which is the highest since sometime before 1990.
Right. Well,
So,
this chart goes back to 2002. It shows a high of what, maybe 6%, above 5% in 2008 when that whole crisis was going on. And then you're saying if we could see more of go to the left on this chart, it would be like 1990 was the last time it was this high.
yeah, the last time you
Okay.
would see these kinds of levels of inflation would have been the early 90s.
Okay.
I'm not sure when the inflationary crisis ended in the U.S., but in Canada it was 1993 that we
Mm,
finally got inflation under control.
right. So we're
So
talking something on the order of it's been 30 years since we've seen inflation at this level. So
yeah,
saying zero inflation seems a little misleading. It's fair to say. Um, yeah.
yeah,
Now you have a. I was going to go to the other chart. Did you want to say anything else about this one before I switch? Black Horse.
not really.
Okay. Well,
If
this
I
is interesting. This is interesting because this is a rubber meets the road chart here. This is U.S. real average weekly earnings. So this is people's income adjusted with a CPI adjustment factor, right? To try to give some sense of how much purchasing power or something like that. How much is your income really letting you buy? Am I saying that right?
That's correct. Yeah, other people will construct it based on purchasing power rather than core price inflation. But
Mm-hmm.
whoever made this chart decided CPI was the way to go.
Right.
This tends to be the stat that USG internally uses to track like median incomes.
Mm-hmm.
So that's why we're referencing it here. And no inflation, but real hourly wages down on the order of 4%.
Yeah.
So
And
it's not.
this red box here is the last 2 years. So this is 2021 and 2022. We see earnings down after being adjusted for inflation, right? The official inflation.
Yeah, that's correct.
Right. Whereas
So
in 2020, it actually shows earnings up, quite positive throughout the year.
yeah, so in 2020, you saw the effect of some pretty severe labor shortages because of because of a lot of the COVID crap. You also saw a lot of countries, not the United States, shut down production of certain goods. And so the US economy got a real boost at the time. In fact, that boost continued on past 2020, where there was relative advantage in operating your business inside the United States versus other jurisdictions. So Americans, if you follow this channel, you'll probably know that Canada was in lockdown for a very long time, but there's like hundreds of these countries that were in various stages of lockdown and had business operations shift to the United States because their economies tend to be tethered. So famously, a lot of the Latin American economies were like that. And then, that ends. You see real declines in real wages continuously after 2020.
You kind of addressed it, but just to be explicit here, Martin Fenton in the chat says inflation in the UK is way above the published rate of 9.3%. It's at least 15% and probably more if you use 70s methods. We didn't say any numbers, but yes, sure enough, if you in the US use the shadow stats version, right, the old way of calculating CPI, then we would be above 8.8% by quite a bit, right, Black Horse?
Yeah. So using the 1980 metric for CPI, U.S. inflation is at about 17%. So,
what was it at in the 70s? In the 70s, that was a very inflationary period. Do you remember how high it got?
The peak of inflation in the United States occurred in 1981 at 15%. So we're above the 1981 peak.
Wow.
Using the same basket.
Or we're zero. Or we're zero, depending on who you listen to. You gotta listen to both sides. You gotta listen to both sides, right? Wow. Above 1981. Yeah. I mean, I remember the 70s and the inflation.
It is worth noting that it's not necessarily the case that the 1980 basket is somehow superior to the present basket.
Sure.
But
just to compare apples and apples, I mean, I think it's well known that the inflation through the late 70s and then right into the beginning of Reagan's term, right into 1981, it's well known that it was pretty bad on the ground. I mean, however you want to measure it, people were really feeling it. I remember it. I was a kid, but I remember the impacts.
If I remember my numbers correctly, I think for the majority of the crisis, where a lot of the outcry really started, I think the inflation rate was only at about 8% or so, which right now seems very cheery and sunshiny. But at the time that was seen as absolutely outrageous because most people had come from generations of a few mistakes compared to today, but mostly sensible policy, and now we are at double digits of terrifying magnitude. So if I remember correctly, the 70s were 8% for the majority, but I could be misremembering. But that does sound correct to me.
Okay, well, let's turn to the next part of our story then. When there's inflation, it's very common that if people have any store of value that they want to preserve, they some extra money, and they'd like to not see it whittled away by the fiat currency becoming less and less useful. They look for a refuge, a hedge. There's various ways to talk about it. A refuge from inflation. And some of the classic ones have been, and we're not going to cover all of these, Black Horse, but let's just try to do a little list. Gold, real estate, silver, I guess, right? But some other precious metals.
Precious metals, real estate. Crypto's kind of a new one.
That's a new one.
But
yeah.
What the hard commodities of various descriptions. So industrial metals used to be, another one. Less popular these days, but there were people stockpiling like copper in the 70s. Kind of a weird thing to do, but
I think I know a few people that still do that.
Yeah.
Okay,
so we thought we'd
let's turn
check in
to
on
it.
the performance of some of these stores, some of these classic refuges, and see how people did who tried to run and hide.
Right. So here's gold. And I had always, well, in the 70s, you really did see this, if I remember correctly. As the monetary inflation was going on, gold prices were climbing, if I remember correctly.
Yeah. So
Yeah.
one of the things to realize about the 70s is, what's the official date of the end of the U.S. gold standard?
Right.
1971.
1971.
Or the effective end would be 1933 or
Well, the
32.
effective end is 1930. The official end is 1970 something.
71.
71.
And so in the 70s, you have an environment where people really have a real living memory of gold as exchangeable to money in the U.S. And so you had a lot of figures in the financial markets who assumed, in fact, if you go back and read the history, there are a lot of people proposing to reattach the US dollar to the gold standard as a solution to inflation at the time. And so there were a lot of people who bought gold thinking that it was going to be reinstated as money
in
the 70s. And so it was a very, very effective hedge during the period. And, there's a lot of institutional memory in the investment industry of people dealing with inflation through buying gold. But if you attempted to deal with 2020 inflation through buying gold, your results would be, as you can see, pretty modest.
Right. Yeah. Now, if you go right to the 2020 line, beginning of 2020, gold is up relative to that. But it's kind of modestly up, right? So it looks like it was, I don't know, in the neighborhood of 1,500. And right now we've got a current price of 1,821. So,
so roughly
not
50%
terrible.
over 2 years. That's not awful,
Yeah.
but it's not. You don't see the repricing of gold as an asset as tightly correlated with inflation. If we went to our other inflation chart and compared it to our gold chart, there would be very little correlation. If we went to our chart of the money supply and charted the price of gold versus the growth in the money supply, you wouldn't see an inverse correlation. Like gold might have performed pretty well over the period, but you're not seeing a classic inflation hedge here.
If I may, most of the people that I know that are trying to buy precious metals aren't necessarily doing so because they think they can it'll hedge well while the dollar is still active. I think most of them are doing it with the anticipation that the dollar is just going to collapse entirely, within their lifetime, which might be something different than what we're analyzing. But most people that I know that are buying into a lot of the stuff aren't doing it with the intent of giving it up anytime soon, I don't think.
Well, I mean, for the purposes of this show, we're reporting on the news that has already occurred.
Right.
What will happen in the future, we'll have to see.
So I figured I would throw that out there, though, before at least people that I know that watch the show will state their intentions to me very clearly after we get off of this.
Okay, so gold is not terrible. You didn't lose your shirt if you saw things getting squirrely with COVID and decided to buy a bunch of gold. You're okay. You're not making huge bank but by having bought a bunch of gold, but it's not terrible. But that is interesting that it doesn't show that correlation that I thought had been very strong at one point. Like basically when the fiat money was looking bad, gold would look good, and it's not seeing so much of that. Housing is interesting. because this looks a little bit better. So this is all transactions house price index, um, and you're using it here, Black Horse, as a rough proxy for real estate, which this wouldn't be all real estate, I assume, right? If somebody just
No,
buys land I want to buy, there's no home on it, that wouldn't go into this, right?
yeah, nor would commercial real estate.
Oh, okay, right. So it's residential house price. Having said that, this is not a terrible way to get a feel for real estate as a common thing people will do is maybe like buy a vacation home. Like if they've got extra money and they can afford it, they'll say, "Yeah, I'll buy a vacation home. I'm sure it'll keep its value, maybe even do well." Right?
Yeah, and they'll get rents attached to it and so on, right?
Right, right. And so this actually doesn't look so bad. It's a little hard to see this is a pretty long chart going back to the 70s. Right at the tail end, you see a little flip up. That is these last 2 years that we're so interested in. So housing is going up. Of course, I keep wondering if we're going to get another housing bubble like 15 years ago, which seems crazy, right? Like they wouldn't let that happen again. But I keep seeing things that make me think that we're literally going to do a rerun of that with inflated house prices. But I don't know. What do you think, Black Horse?
Well, I mean, if you look at the chart, there you can see some prima facie reasons why you might think that. Just if you look at second derivatives, like
Yeah.
I can see why you would assume that based on looking at the price. Whether that turns out to be the case or not, we'll have to see.
Right.
But certainly you see tighter correlation with the formation of price inflation in this chart than you saw in the gold chart. Again, you're looking at like actually in this case you're looking at like 20% price performance over the period in question. So it, certainly better than some things you could have done.
Yeah.
Now,
Yeah, and but
I
you
hate
talked
to
about
tell-
second derivative. I'll put it more simply. If you look at the curve starting around 2005, going into that housing bubble 15 years ago, uh, it looks a lot like the curve that we're seeing in the last 2 years, right?
Well,
got
and
a
you
kind of
you
similar.
have to assume that as interest rates rise, just like they rose in the period between 2005 and 2007, you're going to see some declines in prices.
And I hate to tell anyone that has this as their inflationary hedge. I'm hoping that this bubble actually pops so that I can one day own property.
Yeah,
I got
right. Everyone's
Sorry,
talking about the
turn
young
up the
people.
The Zoomers will be forever an oppressed class. All right.
We're the first generation of serfs since what would it be 1870.
Yeah, I
The
don't know.
beginning of the decline was emancipating you people.
So Black Horse, there's something about house pricing that has been really confusing me, and I don't know if you have any insight on this, but I keep seeing like median or average. I forget which one they're saying. Average house prices are up to nearly $500,000, and I'm like, what? Who's spending that much? Maybe I am not in a high priced part of the country. I'm in the area I'm in is famously a lower cost of living. It's part of the reason my company is here, has the office it has here. We come cheap, and so maybe that's throwing me off. But I'm like, really, nearly $500,000 is the middle price for a home? Did you have any insight on why that number seems really big to me?
Yeah, whereas if you sit in a jurisdiction like I sit, that number seems absurdly low.
Oh,
right?
really?
So,
Wow.
Middle class homes in the U.S. are quite a bit. Middle class homes in places where the urban center has really been degraded in terms of security. So, like all the suburbs around New York, all the suburbs around San Francisco, all the suburbs around LA, the cost of living inside one of those communities is extremely high.
Got it.
So it would not be uncommon to identify large suburban communities around like the greater New York area, the greater Washington area, with median home prices like $900,000. So
Okay,
that's
so
where you're getting your countervailing.
I get you. So this
piece.
is not apartment rentals inside the decaying city centers. That might tell us a different story if we go looking at those. You're saying,
Yeah,
right?
the issue in that ring where all the sort of managerial class people tend to live around American cities,
Mm-hmm.
you have a lot of very expensive housing from people who work inside the cities, or increasingly work on laptops in their basement, um, and yet want to have that sort of that basic security. And
Got it. That's interesting that you
these
connect it to the security issue. I hadn't thought about that, but
Well, I mean, the security issue is the nice version of that story. There's
sure,
also the
sure.
racial version of that story.
Right. But also, to be fair, like with New York City, I was hearing, and I haven't checked up on the story for a while, but I was hearing that people were just getting out because of the restrictions
Yeah.
and stuff. People were just getting out of Manhattan, and where are they going? Well, if they're going to continue to work in that area, they're going to go to, like you said, sort of surrounding suburban neighborhoods and bid those prices up and stuff. Right.
Well, what you've seen across urban areas across the West is what one of my friends at TD calls a flight to private space, right? So if you look at the waiting list for every private club in like a major urban area in the US, you'll see giant waiting lists and huge entrance fees. If you look at prices for land that's commutable to these areas, with like properties with large backyards, that kind of thing, you'll see big increases in prices very, very suddenly as a consequence of the events of 2020.
Right.
There's the issue of security. There's the issue of having space where you privately set the policies, rather than, public venues have to have certain standards that they have to follow, right?
Right. Right. Okay. So think like gated communities is what you're telling me.
Think gated communities, think private golf clubs, think
Right.
like all that kind of stuff.
Yep. Yep. Got it. Yeah, and as I mentioned, every year we have a family vacation to a private sort of resort community where you go through the security gate and then you're within this. They own the roads. They set weird speed limits that are very low speed limits. And they're like drive slow, chill out.
Yeah,
You're in a new
my
world
grandparents,
here.
every time you got in their community, they had the speed limit sign 21 miles an hour.
Exactly. Right.
Oklahoma, yeah, Oklahoma small towns will have like 15
Oh my
miles per
Right.
hour in some areas.
Right, and so what I always share, Black Horse, I don't know if you've heard me talk about it, but this place, it's about an hour west of here where we go to vacation each year. It is palpable, the feeling of safety when you enter through the security gate. You are now like in a different world. It's you didn't realize the background noise of chaos that you're just surrounded by all the time until you go into this community and it disappears, and you go, oh, this is what it's like to feel safe, you know.
Yeah.
Anyway, so that sort of thing or anything near it is maybe reflected in these house prices going up. That's quite interesting. Okay, so real estate, at least for the moment, might be has been a bit of a hedge, though I get a little concerned that we're going to see a crash, a bust again, right? Um, so we'll see about that. Now, what about Bitcoin? It was looking pretty exciting at certain points in the last 2 years. As you can see here, this chart goes back to 2019, beginning of 2019. So it shows 1, 2, 3.5 years here, the last 3.5 years. And Bitcoin was way up during certain parts of the lockdowns and so forth. And then it has just crashed this year, not back to where it was in 2020, but it's half or less than half of what it was at its peaks. Do you have any story to tell here, Black Horse? I actually have been wondering about this myself because a kind donor wanted me to have skin in the game, and gave the show me and Matt Merck skin in the game. So he gave the show enough Bitcoin, shall we say, that we are interested in what happens to the price. And so I notice these things and I'm like, wow, I'm not selling that Bitcoin right now. It's not what it was when I got it, you know? So do you have any thoughts on
Yeah.
this?
So I mean, Bitcoin is a younger market. It's harder to tell a credible story about the sources of its price fluctuations. I will go as far as to say that what you're looking at when you look at the chart of Bitcoin price is not, there's no direct relationship between this and any marker of inflation you might want to choose. This is
Yeah,
a
right.
market that is responding to sort of mimetic impulses due to the emotion of people who want to buy or sell Bitcoin.
Right.
It's
So
not a market that's
this is a
responding to.
story. You're saying this is a story about Bitcoin, not a story about larger things.
It's a story about Bitcoin. It's not a story about the U.S. dollar.
Right, right,
Whatever else it might be a story about.
right. You don't see any correlation between this and price inflation, this and the value of the US dollar against other currencies or anything like that. It's just off on its own little journey,
Yeah,
vision quest or something, right?
something like that. There may come a time when we see anti-correlation between inflation and cryptocurrency, but that time has certainly not arrived.
Right, right. Yeah, which is kind of surprising, right? Because I think some of the Bitcoin boosters would have said that, hey, you know, if they were foreseeing the inflation of the fiat dollar, they'd say, hey, Bitcoin's a great place to keep safe. It's just going to go up, 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 and it has not. It has actually dropped quite a bit over this year. Um,
Yeah,
so not
that's
sure what to
correct.
draw from that,
And part of
but
that, one of the things you should draw from it actually is that assets like Bitcoin, assets like high growth tech companies, as interest rates rise, tend to be very, very vulnerable, because as rates rise, there are time preferences change, and so people take high growth assets and convert them into things like bonds or
mm,
things like um, utility companies, low growth, high revenue production assets.
low risk is what I'm hearing from you.
Yeah, low risk is correct,
There's a
because
flight into
they
low
start to be able
risk.
to produce. That's right.
Yeah, yeah, right. They used to call them like blue chip stocks, right? These are the ones that just are not risky at all. You're really, really safe having the stock, for example, that kind of thing.
Yeah, yeah. Although that term kind of died in '08, but
Right, because
that is what
there
people used to call them.
there were no blue chip stocks anymore. Yeah. Okay, so that's the talking a little bit about the larger inflation story and potential hedges against inflation, looking for a refuge from price inflation, for example. Let's come in. We're going to come back to the larger story, but let's focus in on a few things that we've talked about over the last half year, in some cases over the last year and a half. Here is something that's quite interesting. Here's wheat, which we'll use here as a reasonable proxy, right, Black Horse, for um, food and agriculture. Well, we'll look at one more
Yeah,
agriculture, but you know, price of food is going to be heavily affected by things like wheat and soy and stuff like that, right? And
yeah. So before the
it
show,
was yeah. Go ahead.
we did a before the show we did a pretty comprehensive review of the ag markets. So these, we just pulled wheat and live cattle as two examples of futures that
Right,
represent broadly the ag industry. Wheat in particular had been subject to this big disruption because the region of the Ukraine is such a large producer in the global market. And so
right,
you saw wheat, unlike a lot of other commodities, really was quite affected by the disruption of the Ukraine war.
mm-hmm,
That line drawn on there, that's my line. So that's
mm-hmm,
just a long-term trend line. So you can see we've come all the way out of the disruption and we're right back on long-term trends,
right.
um,
And literally, this
without any
disruption,
kind
if I'm reading the chart correctly, it looks like literally it spikes up when the war starts, right?
yeah, and it
That's
goes
the
up
beginning of
almost
that.
50%.
Yeah, so it is quite dramatic for a while, but then it's back down, and it's been like half a year, right?
Yeah, so it's back down since I guess that's like late July. That's like late July.
Yeah, even
Since it's
maybe a
been
little bit
down
less
as it
than
is.
half a year, and it's just we're okay again in wheat, which you pointed out is interesting because we have some friends who are talking about how, we're all going to be starving soon. But you're saying the data doesn't support that story. But it was scary. A couple months ago, you could see why people would start feeling concerned, right? With these kinds of increases,
Well,
if it looked like if it was going to keep going in that direction, we could be headed for trouble. But it didn't. The market adjusted, right?
yeah, and so like there's two stories going on here. There's a long-term trend line that is concerning, right? So
Yeah,
you
well,
look
that's
at the
true.
2-year trend for the price of wheat. You see prices rising due to underlying kind of structural problems. But
Mm,
what you don't see is the kind of hyperacute problem
yeah.
that you see discussed in media a bit at the moment, and
Hmm.
particularly discussed in dissident media a bit.
Right. Yeah, I mean, basically, if that spike up at the war had just kept shooting up at that rate, that would be a pretty dramatic story, right? So
Yes.
for a month or two or three, you could see someone drawing a different kind of line than what you drew with a much greater slope and starting to get pretty freaked out, right? Um, oh,
Yeah,
so
yeah.
before we move away from wheat, to what do you attribute the correction back to that long-term trend, which isn't itself great, but it's not as scary as it was for a couple months? What do you think's going on there?
Uh, Well, I mean, there were fabulous harvests in North America this year, so
Okay.
that's at least part of the story.
Mm,
But at a broad level, the story in the agricultural commodities market is that uh, the regime which is inhibiting farm production in places like the Netherlands uh, doesn't have control of all the places in the world you can plant things like wheat.
hmm.
In fact, not even close.
Yeah.
So there's a lot of other supply that can be made available over time by the increased prices, and so you saw, within 3-4 months, people were able to deliver additional supply of wheat, even though there's been a lot of talk about restarting grain shipments out of the Ukraine. Production there is still way down.
Um, right. And so one part of the story I want to tell here, and we'll see more of it in a moment, is that the market still, despite everything, and we're looking at sort of an international story, as you mentioned, right? Certain parts of the wheat market, like Ukraine and the Netherlands, have been damaged by various state activities. Um, but then other parts of the international wheat market are, you know, kicking in and making up for it. So that's kind of sort of the classic story of the economy, right? Is that, um, if you don't literally have a one world government shutting down wheat production everywhere, there's a good chance that the market will respond to high prices, and people will come to market with more wheat, right?
Well,
and, and
especially in a
and that'll bring the price
se-
down. So
especially in a commodity sector as broad as agriculture, where there's lots of
yeah,
ability to substitute, there's
yeah,
lots of methods that you can use. You know, you have problems in right now. There are problems in the nitrogen-based agriculture, or sorry, the nitrogen-based fertilizer
yeah,
segment, and so
right.
there are other kinds of fertilizers you can use. There's other techniques, and
Hmm.
so I would just say that the charts here are telling you that whether there's structural problems, whether there's structural inflation or not, you're not looking at a hyper acute problem.
Right. Yeah, we've got a long-term trend we don't like, but what was looking like, starving this winter, it doesn't really look like that at this point. Okay, well, let's look at cattle as just one more data point. This does not look like such a dramatic story. In fact, I have trouble seeing where the war is here. The high
Yeah,
point
I
is
pulled this
not
chart
recently, it's
because
it's some years ago. It's what, 8 years ago is a higher point than where we're at now, right?
yeah, I pulled this chart because over early summer, there were all kinds of stories circulating on Twitter of people identifying large cattle culls across the
Mm-hmm.
Midwest, and trying to take from that the argument that there's going to be a really severe disruption in the beef market,
Mm-hmm.
and that story really has not played out the way that it people in on that narrative would have expected it to play out.
Right. Yeah, I mean, it looks like it's a local maximum over the last couple of years, right? Nothing like 8 years ago, but a little bit high compared to beginning of 2020, something like that.
Well,
But
and remember, this is
not that
not
big of a
this is
deal.
not an inflation adjusted chart, right? So if you try to
Uh,
adjust that for inflation, we're way below where prices were in 2015, for
oh,
example.
okay, got it, got it. I see. Okay, and then gotta since we had so much fun with it a while back with the lumber memes, we gotta look at the lumber story. Thanks for bringing this up, Black Horse. This is showing the last 5 years roughly, and you see some two big peaks. One hits there in like mid 2021, and another in March 2022. But it's settled down again. Yeah, what? Why were we getting all these lumber problems? I'm trying to remember.
Well, so we had this very interesting effect where you cut off the ability to consume typical consumer goods. And so a lot of what would have been consumer spending was redirected towards real estate investment.
Hmm.
So things like housing starts went through the roof,
Right.
etc. At the
Yeah.
same time as there was a lot of strain on supply chains, and so you got lots of shortages of wood during that period, really peaking during the two periods when the northern hemisphere was most locked down.
Mm-hmm.
Um,
Got it.
so so you had these kinds of very interesting distortions in consumer behavior with regard to cash, and then we appear to have resettled. Remains to be seen whether we're in one of these local normalization periods and whether
Mm-hmm.
there will be lockdowns and a spike again this winter. But
Right. Right.
uh, I mean, it looks to me from this chart like what we're looking at here is a market that, assuming we don't do anything bad to it all over again, is ready to renormalize.
Right. Right. Yeah, the market doing its thing. So you were saying there's a larger lesson to be drawn from this quick survey of some of this good news. Oh, and we also, and I think our last econ minis, we had highlighted that um, oil is coming down, gas prices at the pump are coming down. People have probably noticed this themselves, but just to summarize, we're seeing some good news even in some but not all of the energy market, um, the lumber market, agriculture. So there's some good news here, and but in fact, let me bring back the wheat chart while you talk about how to think about this
Yeah, so
structural versus sort of the dramatic episodes of the last year or two here.
so over the last year or two, we saw some really severe acute problems in some of the underlying commodities. Wheat is a really good example. Right now, we've got a really severe acute problem in the natural gas market in Europe. But we've got what I wanted to highlight from a chart like this is that we've got both an acute and a chronic story. And the acute story is actually resolving quite nicely across the Western world.
Right.
Um, Whether that, depending on the commodity, that has to do with the surfacing of new supply due to price increases. It's got to do with the resolving of some of the supply chain issues that have occurred over the last 2 years. But the
Mm-hmm.
structural problems are still there. Whether those problems are structural problems in the monetary system or whether they're structural problems in the inhibition of uh, the surfacing of new supply, like they are in the energy markets, those structural problems that set up the conditions for acute crises still exist, and
Right.
we should understand the sort of not yet and all at once that exists in economies like this, where um, the fact that you saw a 50% spike in wheat prices as a consequence of what by historical standards is a fairly minor geopolitical event, the invasion of Ukraine,
Yeah, I thought
suggests
about
that
that.
it's very, very possible that that kind of thing or worse could happen again, right?
Right.
The fact that you're seeing Europe, you know, Deutsche Bank came out this month with a series of risk cases for Germany for the winter that included the substitution of natural gas with wood burning heating for the winter as like an expected scenario. So the fact that you see that as a response to you know, not a minor, but the Ukraine war is hardly unique in history in terms of its scale. Suggests that what you're dealing with is an extremely fragile system, and it's a system
That's
that appears
interesting.
to be becoming more fragile as a consequence of some of the strictures that are being imposed on it.
Right. So this line you drew here on the wheat market shows wheat climbing. It's climbing. That's the first thing to say, because as Julian Simon pointed out in the Ultimate Resource, the long run trend is for basically everything to get cheaper except for human labor. Um, so this is counter that long run trend right now, where we're seeing rising
Yeah.
prices. Right.
So remember again, this is not inflation adjusted, but that's quite a bit
Yeah.
more than inflation, right?
Mm-hmm.
From 6,000 to 7,900 over the course of 2 years. That's whatever it is, 30%, 25%.
Yeah.
So
Yeah.
that may represent a monetary phenomena, or that may represent uh, a regulatory phenomena, but it's underlying and structural.
Yeah. Right. Right. And the problem is we have these temporary blips, not very fun while they're happening, but temporary spike up of gas prices, of wheat prices, and so forth. And that is not fun in the short term. But I think, when you think about, I shouldn't talk about compounding, but it's that slow drip drip in the wrong direction that ends up being more scary, I think. Do you follow what I'm saying, Black Horse?
Yeah, yeah, and that drip drip also sets up an environment that's vulnerable to crises, right?
To more crises. That is a
If
very interesting point. Yeah.
Europe had a robust energy market prior to 2020, or prior to 2020, well, prior to 2020 anyway,
Mm-hmm.
you would not have seen the same kind of acute disruption. If there was, a robust supply chain that didn't have a lot of very vulnerable nodes, we would not have seen the kind of price shocks in lumber that we saw. If you had, and this story repeats over and over again across the commodities, right?
Right. Okay. Anything else on this? I was going to go ahead and go to some tips and super chats. Black Horse.
Let's go.
All right. Okay, we just got a few things. Sam153 says low time preference tip. Thank you, sir. And he used tipping on Subscribestar. And by the way, I think I just saw someone say if I have a tier where people can join without paying a monthly thing, then they can send in tips through Subscribestar instead of YouTube. I should do that. I didn't even realize that. And then people, they still have to like join, right? But they don't have to sign up as a monthly thing. And then they can just tip through this instead of using Super Chat. So I'll set that up. That seems cool because I get more of it that way, and Google gets none of it, so that's better. Let's see, and then we have a few super chats here. Narco Republican says talking about video game economies, which was very funny, Black Horse, that you said that. At some point, the World of Warcraft coins were worth more than the Venezuelan bolivar. An outage in the game servers caused many Venezuelans that made a living out of mining video game coins and selling for US dollars to lose their incomes. So, wow.
Yeah. Well, the term video game economy really came from the World of Warcraft real
Mm-hmm.
cash store.
Right.
Blizzard tried to do this with a couple of other games. They did this with Diablo 3. I think there was a similar kind of thing going on in EVE Online where somebody set up like a bank inside the EVE Online gaming world
Mm-hmm.
that lasted for a couple of years and
Wow.
accumulated something like $500,000 of real world equivalent assets.
Wow.
So,
Um, okay. Yeah, Jimmy Jimmy Thomist says, I'm pretty sure inflation is only because of Putler and it's Holocaust denial to claim otherwise, or have I missed a code switch? uh, great comment. Um, yeah, that's another thing. I mean, the I think it was actually said at one point by the president, Black Horse, right, that you know inflation was being caused by that war, and obviously there
well,
were
their
short term
brand is it's the
impacts.
Putin price hunt hike, right?
Is it
Right, yeah,
okay? I
and
hadn't heard that.
I believe that Comrade Thomist has got his programming wrong. There's no inflation now, Comrade. Cease your counterparty propaganda.
That's right. Good point. Um, okay, Cringe Walker has a very subversive super chat, and I'm not going to directly reply to it because he's trying to pull me in, Ryan. He says, what I'm hearing is a Democratic majority in November. Okay, here's the
If
little line I've been using, okay? It's like aliens land, and for real, like the aliens land for real, and everybody's seeing them, and they're like, "Oh my goodness, aliens have landed." You cut to the commentator on the news show, and they say, "But how will this affect the midterms, Jan?" Right? I mean, it's like I am so sick of everything that happens being like, "How will it affect the fortunes of the Republicans and the Democrats?" I don't really care, you know. That's what I say to your question, Cringe Walker. Who cares?
it, it might
Uh,
be considered political theater.
exactly.
Cringe Walker, I believe in the blue wave. I believe in the blue wave.
You know, if only we had more people like Cringe Walker who would just vote blue. Then we would finally get our desired blue wave, and the Uniparty can just become formalized.
All right. Well, time for me to go pick up my car and drop some inflated dollars on them. Um, and thanks so much to Ryan and Black Horse, and I'm loving it. Ryan is really learning from Per Bieland. He was at Mises U, and he's bringing the Austrian econ, which I have deep in the recesses of my mind and sometimes on the surface, but sometimes I feel rusty. Like I'm like looking at the Hayekian triangles and my mind is just like freezing up. So I was really appreciative to have Ryan here.
If you don't mind, if I could chill something right
Yeah,
before we
oh,
sign
please.
off.
Yeah.
As a result of going to Mises U, I came into contact with a lot of people. I am revising an article for Mises.org, probably
Excellent.
tonight. I didn't write it as good as I probably could have, so I will put more time into it later today, and hopefully that will be going up if it gets accepted. But also something that is already out, the only clergyman in attendance at Mises U was a Lutheran pastor by the name of Reverend Larry Bean. He has a website called Gottesdienst, which is terrible, scary German that our English ears probably would not be able to spell too terribly correctly. But if you go check my account, my Telegram, my account on Twitter, excuse me, you will see I have an essay on that journal that is already published. My first thing that I have actually sent out that has actually made it to publication. Go check it out, and there will be more coming soon. I tried to send something to Lou Rockwell, and he has yet to get back to me, which suggests to me that I've got a wrong email or something. But go check all of that out. I'm taking off, as you can say.
Yeah, I'm trying to find that
Support
article
Ryan
really fast.
Turnipseed's burgeoning media career. So.
Yeah, I'm trying to find that article real fast, Ryan, so I can drop it in a live chat. Oh, there it is. I got it. Okay, here we go. Yeah, how do you pronounce the name of this publication? It's German.
Gottesdienst.
Got it,
Is
Steenst?
that- well, I don't know if that's how it's actually pronounced. That's how literally everyone I know, including Reverend Bean, that's how they pronounce it. So my bet would be that's the correct pronunciation, but there is the slight possibility that that is an Americanization that is just going to become its own cultural word.
The just to I just dropped the link, and just to draw you in, it's called The Idolatry of Pointing Out Idolatry by Ryan Turnipseed. So it's great fun, actually. The sort of thing Cringewalker would like, right? Definitely.
Perhaps.
Okay. Thank you both, guys. I'll be off soon, but I think Ryan and I will hopefully fit in one more in the Left Wing Terror series next week, and then the show will be off for a couple weeks for me to have a vacation and go speak in England and stuff like that. So it's going to be cool.
If I get your blessing, I might, host my own sort of knockoff econ chat on my channel, just because there's a
Yeah.
lot of things we don't get to that I would like to talk about.
Yeah, that'd be great. Yeah, I'm happy to show it.
Alrighty, awesome.
Okay, cool. All right. Thanks, Black Horse. Thanks, Ryan. And here we